have on this call. And it's important because it gives us foundation to, a lot of things that I've been talking about, right? Now, if you guys have been with me, there's something that that I teach a lot of times, and that is as it relates to price and time, narratives and perspective ideas. Okay. So here is the thing. I've come to figure out that in the market, time is more important than price. In actual fact, time is everything. Okay, it is the foundational base of how the market basically moves and books, with relation to algorithmic perspectives and theory, as well as with relation to obviously the understanding of, settlements, clearinghouses, central banks, and all of that. Okay. Now, there are certain elements that you apply in trading, okay, when you want to put yourself in a position of being able to be profitable or being able to make money. Now, that for me is something that is very, very interesting. Okay. Now, what I want you guys to basically notice is that there are strategies that you use when you want to paint an idea as it comes to relating to the markets and when it comes to relating to the charts. Okay. So perspective gives you the understanding of, learning narratives in the market that actually cause you, to move and actually become, net profitable. Okay. Now, I don't know how important this is, for some of you, but I can tell you that for me, it is at the order of importance, the issue of time. So what I'm first going to be doing today is I'm just going to be going through price action, and I just want to look at a particular stock. So we're going to be making an example of this stock called NASDAQ. And the reason why I'm just going to be making an example of the stock is that I just, on a personal basis, love the stock a lot. And but we could actually look at any other stock or any other currency or any other gold or index, whatever it is that you guys essentially would want us to look at. Okay. Time is very important. Time is more important than price. Okay. I cannot allude to you how important this is, but for me personally, it has caused me to have a lot of understanding as it relates to why the market basically moves the way that the market moves. Okay. So there were perspectives, obviously, that I was trading this week and last week and the week after, or the week before. And I was looking at trading the 3:30 equities open. And I was essentially also looking at the 2:30, manipulation without high impact news or without economic calendar events. Okay. So it is very much feasible if you understand time narratives and you understand perspectives in the market, that you can build a narrative that actually causes you to begin to level up when it comes to your game, and when begin to level up when it essentially comes to understanding narratives and perspectives when it comes to trading. Okay. So the first thing that I'm going to do today is I'm just going to show you time. Okay. Remember last time we went through yearly ranges in terms of what happens throughout the year. And so today, the reason why I went through that was just to show you guys what basically happens at particular moments or particular times when you are looking at price during the year. Okay, because there are 4 primary drivers in terms of market moves, and one of those market drivers are seasonality in the market. Okay, so the market moves a particular way because of seasons. So seasons, depending on the season that we're in, the market is going to offer some measure of move. So if you are looking at starting from the 20th of December to the 30th, going on to Thanksgiving, Christmas, and all of those things, you would understand that the market offers very bullish moves, okay, or offers very bullish momentum. Why? Because that is based on seasonality. That is based on time. that is based on season perspectives. So when you then come to understanding, you then come to realizing that there is a lot of season moves throughout the year that begin to happen. Now, on a normal base, okay, the year from the date from January to about April, that is the yearly accumulation. Then we have April to May, that is the yearly manipulation in the market. From May all the way to November, that is the distribution. And then what December does is that December would normally reset the yearly range. So a lot of times when the December month comes, we either trade into an order block that we created in November or October, basically. Okay. And when January comes, then it's a reset of the year. So it is very much feasible and possible to take a trade at the beginning of the year and to hold the trade for 2 or 3 months that can possibly give you pips of over 1,000, 2,000, 3,000, depending on what you are essentially looking at. Okay. So what I want to do this time round is I want to go on my chart and I want to look at the monthly range in terms of market moves. Guys, I am telling you this, dates in the market and times in the market are very important. That's why I say that this session is going to be very, very important. Okay. So I want to speak about two things. Number one, I'm going to speak about the concept of order blocks, but also I'm going to speak about taking trades, okay, on what you call institutional levels. So if you have an order block and you mix it with your institutional level, that gives you a very great idealistic move in terms of your narrative. Okay. And then maybe we might talk about we might basically talk about institutional extension points where you would basically look at market moves. But it's something that you guys know. But the reason why I call it the way that I call it is because I want you to begin to understand why it's called an extension, okay? And how you then mix those up on, daily narratives and basically where the market is likely to go. Okay, so from now, I want you guys to listen to me very carefully because I'm going to be giving you a very precious information that you are essentially going to need to build your bias in the market. Now, you can remember that we haven't spoken about market structure yet. We haven't spoken about structure. We haven't spoken about and the reason why I have not done that is because I first want you to understand time narratives. Okay, are we still together, guys? So if we are still together and you are ready for me to share, just type 11111 on the comment section. Okay, if you say to me that Q, I'm ready to start, I'm ready for today's session, just type 11111 on the comment section for me, so that I may also be sure that I've got people that are really hungry to start. Okay, so I see the couple of 111s from you guys. All right, so that's well done for that. Okay, so let's obviously continue moving and let's just build and create narratives in terms of what we basically want to teach today. Now, guys, there's something that I really want you to understand that is very, very important. Okay, number one, time in the market is critical. Okay, time in the market is absolutely critical. On a personal note, I normally say that time in the market is almost everything. Once you can understand the advent of time, you can essentially understand everything else that goes on in the market, because it gives you very important foundation for understanding the way that the market books and how the market basically books in narratives of time. Okay, so let us start obviously with this. Now, here's one thing that I do suggest. If you are a Forex trader, okay, there's no need to analyze every single stock in the whole entire world. Okay, there's no need for that. What you possibly can do is find one that resonates with you, and then use that, practice on that, build on that up until you've mastered that. Because the goal is for you guys to make sure that you make money in the market. Okay, so if you found a stock that you love, be it whatever stock it is, use that and just highly make sure that that is what you use to execute on into the highest level. You understand it and you make money on that, and then you can eventually focus on looking at all the other stocks out there, and all the other currencies and so forth. Okay, but I'm not really negating you from doing that, but it's also very critical to find something that you on a personal level resonate with, and something that you basically use to build your own narrative when it essentially comes to the market, and looking at specific moves in the market. Okay. All right, so let's get it. So if you will see my screen, just do mention to me, or just do type it out to me that you see my screen that I will be sharing at this particular moment. All right, so if you guys can see my screen, you can just maybe perhaps unmute yourself and tell me that I can see your screen, my leader. Okay, not yet. Okay, cool. So you guys not yet. All right, that's fine. Let me just make sure that the screen option is available for you guys to begin to see. So just hold on for me, right? Okay. All right, so I've got my chart open, and the first thing that I'm going to be dealing with here is the aspect of time. So on a personal level, okay, I'm just going to be dealing with NAS for now, and then we can always go to US30 and other projects as well. All right, so this is very, very important for you guys to begin to see this. Okay, so let's mark off time. And guys, I'm telling you right now, this is going to change your perspective if it has already not changed your perspective yet, but it's going to change your perspective. So there are two times that I want us to mark off. The first time that I want us to mark off is at the end of the month. And the second time that I would like us to mark off is at the beginning of the month. And the third time that I want you guys to mark off is as the charts are essentially approaching end of the month. Okay. Now listen to this very carefully. Okay. So towards the end of the month, the market is always going to offer some bullish momentum so as to close off the month. And then during the first week of the month, the market will always want to retrace from that high that is created and to a particular order block. So the first week is always a retracement, okay, from the high that was created from the end of the month. Now, why this is important is because what you need to understand is that every single day in the New York trading session, okay, what basically happens is that when the New York trading session goes towards an open, it offers some very big bullish move up or big bullish move down in the form of expansion ranges. Why? Because of what we call market on close orders. Okay. So there's what we call market on close orders in the market, where the market will begin to offer some bullish momentum and some bearish momentum based on the time, that it essentially closes. Okay. Now that is actually very, key, and it is important to actually building up, your narrative. So there is a constant thing that basically repeats in the market where you look at either mid-week, okay, or you look at mid-month, right, or you look at mid-year, okay. It is a repetition process. Now, what you guys need to begin to understand is that the market is fractal. So the fractal nature of the market basically means that the market is essentially able, okay, because it is a fractal market, it is essentially able, all right, my goodness, let me flow. Because the market is fractal in its nature, okay, what that basically means is that the bigger perspective of your candle narrates your smaller perspectives, okay? What that basically means is this, right? If you have essentially got a 1 month chart, okay, your month chart is inclusive of 4 weeks, okay, 4-week candles. So this one candle that you basically see over here, bearish candle, is actually 4, okay, week candles. So it's 1, 2, 3, 4. And those 4 candles, they make up what? They make up a month. Okay. So you can basically see, even as I've narrated it here on the chart, right? So this was the first 7th of August. This was on the 14th of August. This is the 21st. And the next candle is going to be the last candle, which is going to narrate, see, the 28th of August or something along those lines, right? So what you need then to understand is that the market in its nature is very fractal. So the higher time frame perspective narrates what is happening, or the lower time frame narrates what is happening on the high time frame, and the higher time frame narrates what is happening on the lower time frame perspective. Okay, so if you are looking at this monthly candle, what you are basically seeing is a lower time frame objective. Okay, it is a lower time frame perspective, in the sense that because the market is fractal, this 1 month candle is going to include 4 1-week candles. These 4 1-week candles will include 22, for example, or 22 day candles that basically make up that particular month. And it goes on and on and on and on and on. So when you delve into the lower time frames basically give you a more detailed perspective of what is happening on the higher time frame. My goodness. So here's then what you then need to understand, okay, guys, that the market does not move the way that it does by accident, but it moves the way that it does based on narratives and the understanding of time factors. Okay, so what this basically means is this, and it's very, very crucial for you guys to understand this, right? So the date was on Friday, and Friday last week. And I said to someone that you need to begin to look at the trade that you are taking right now is a trade that is going to give you many pips. Okay. Now, number one, it happened exactly at 10 to 11 New York Standard Time. But not only did it happen at that particular time, but the market reversed, within that specific date.
So when you understand dates, that's when then you can understand how to hold a trade for long-term purposes. So when we are talking about extension institutional numbers, and we are also then talking about order blocks, you would find one thing, okay, that us, when we use those perspectives, we don't post the chart every single day, maybe, because you only find these at particular times of the month. So when you find a particular trade at a particular time of the month, it can actually cause you to begin to hold on to that trade for a very, for about a month or for 50 days or anything like that. So it is possible for you to take a trade on the 15th, on the 30th, on the 1st of July and hold it up until the 1st of August. It is very much possible. As much as it is possible holding a trade from the beginning of the year to holding a trade to the end of the year. Because when you understand this, that holding a trade from the beginning of the year is understanding that, the market has, obviously December has reset the yearly range, but also understanding perspectives and dynamics in terms of what is happening globally. Now, the reason why I like stocks is because stocks are buying markets. A lot of the trades that you'll take either on a monthly time frame, either on a weekly time frame that you want to hold for long, will be sustained by longs that you take more than it will be sustained by shorts, okay? A lot of times. Now, not to say that it is like that every single time, but a lot of times when you are looking at stocks are a buying market. So they actually cause you to, elevate in terms of, looking at your perspectives when it essentially comes to trading. Now, there are a few things that I would need you guys to watch, and I need you guys to basically look at, okay? And I'm going to ask you guys these questions. Now, watch over here, okay? Now, watch over here. I want you to be aware of the turning points. I want you to be aware this is a turning point, okay, in the market. Number one, this is a turning point, okay? Now, we're going to go and we're going to look for another turning point. This here is a turning point. Okay, now I'm going to look for another turning point. This is in the month of July. Let me look for a turning point again. Boom, there's another turning point. This is the month of June. Let me go, let me look for another turning point in the month of April or in the month of May. Okay, let's go. Here's another turning point in the month of May. All right. So there is something very strange that I'm noticing in the market. And when you open your eyes, you will basically see that this is the same thing that comes and it repeats. Okay? Very, very critical. Now, what I'm saying to you guys is I want you to begin to note this thing, because on an honest truth, some people would never really get to share this because to them, it is their own kind of information. But look at what I'm going to be sharing with you today. Look at what I'm going to be sharing with you today. Watch this. I'm going to take and I'm going to draw my horizontal line here. The reversal in the market happened on the 18th of August. 18th of August, which was mid-month. Okay. I need you to watch this thing very, very carefully. 18th of August. This was mid-month. Mid-month, anything from the 15th to the 18th, to the 20th, it is mid-month. Now listen to this, watch this. Reversal condition happens on the 18th of August, mid-month. 18th of August, there's a reversal condition in the market. I'm going to come here. My goodness. 19th of July, there is a reversal condition in the market. My goodness. Anything from the 15th to the 20th, reversal condition. Okay, let's go. 16th of June, there's a reversal condition. My goodness. Sixteenth of June, there's a reversal condition. Look at this. And this was last week, Friday. This was last week, Friday. The market went from here all the way to here, which would have given you over 400 pips. Now look at this thing very, very carefully. Okay. You see, when I talk about time, when I speak about time, understand what I'm saying to you guys very, very well. Because time in the market is everything. It is everything. It is no accident why the market does what it does on particular days of the month. It is no accident. So if you can learn to understand times, okay, you can basically learn to understand when to expect maybe a next buy or when to expect a possible short, even before the market gets there. Why? Because you understand the narrative of time. You understand the idea of time. Okay, fine, very well. Let's go on to the next date. 19th of May, 18th of May. Reversal condition in the market again. Here, boom. 18th of May, reversal condition. And we can go on, and we can go on, and we can go on. Let's look at this. Let's look at this. My goodness. 18th of April, there's a reversal condition. Oh, yes. Oh, yes. Oh, yes. Oh, yes. Oh, yes. Okay, let me rather choose. Let's choose it from the 15th of March, and I'll tell you why. There's a reversal condition. Okay. My goodness. My goodness. 16th of February, there's a reversal condition. Oh my goodness. My goodness. 19th of January, there's a reversal condition. January, there's a reversal condition. Market mysteries. Look, now I want you to begin to, we're going to break it down. I want you to watch this. There's a reversal condition here. One, mid-month. There is a reversal condition. This was in February. There's a reversal condition here in January, mid-month. 15th, 16th. 19th, 16th, 15th. There's a reversal condition here on the 15th of March. Market mysteries. There is a reversal condition here on the 18th of March. There is a reversal condition in the market over here on the 18th of May. April, May. Okay. There's a reversal condition here in June. Mid-month again. There's a reversal condition here in July, mid-month again. There's a reversal condition here in August, mid-August. Okay. Now, so there is something that happens in the market during the middle of the month. That is number one. Now, watch, because this is going to be vital that I'm telling you. Then we look at the first week of the month, of the new month, okay? Because there's going to be a bullish expansion, okay, in the market when it comes to the last week of the month all the way to the first of the month. My goodness, my goodness. My goodness. Now we reveal such mysteries. Now we reveal such mysteries. Now, here's one thing I want you to notice, okay? Now, I want you to basically watch what happens in the market, okay, during the end of the month, and what happens in the market or towards the end of the month, what happens to the market during the first week of the month, okay? And I want to go through this so that I can show you why it's not a cherry-picked idea. Before we even get to extension institutional numbers, I want to show you this because this is very important. Guys. And if you may open up your ears and understand what I'm saying to you tonight. Understand what I'm saying to you tonight. It will change a lot of things when it comes to perspective. Now, I'm going to mark off the first of every month. First of the month. Okay. Here's the first of the month. So this is the 1st of August. Sorry about that, guys. My goodness. My goodness. So this is the 1st of August. Look at what I'm saying. Let's mark off the 1st of, this is the 1st of August, end of the month. Okay. Now watch what I'm going to be doing. Am I not sharing my screen?
Yeah, your screen is not showing.
Okay. All right. Now look at this very, very carefully. Okay. Look at this very, very carefully. Now I've marked off the 1st of, or let me rather say, so this would be the 1st of, this would be the 1st of August. Okay. This would be the 1st of August, and this would be mid-month of August. Now let's go on and let's mark another 1st. Okay. Especially when it comes to this. Let's go on, let's mark another 1st. Oh, yes. So this is 30th. Sorry about that. And let me go ahead and let me mark the 1st. So here it starts on the 3rd of July. So 3rd of July is essentially over there. That is fine. Okay. It's not a problem. Now let's actually go. So this would be the 1st of August. This would be the 3rd of July or 4th of July. Just fine. Probably there was a weekend over there. Let's go. So 3rd of July was on Monday. Let me mark the 3rd. It's fine. Let's continue going.
That makes sense, King, because it's Independence Day coming in the United States.
Now watch, 100%. Now watch this. Now watch this. Because time is very important. Now look at this thing, guys. How is it that the market meets a reversal condition every 15th of the month? That's number one, okay? What I'm going to do is I'm going to share strategies, obviously, on the next sessions of gold and all of these particular, if you guys are trading gold, I'm going to show you the gold strategy. Gold doesn't obey structure. And hence why gold, puts other traders out. It doesn't necessarily obey structure, but there is something that it does. And I'm going to show you in an extension +1, extension +2, and how those basically works in relation to strategy. You can trade absolutely anything and you can kill it, guys. I'm telling you right now, the level of information that I'm going to be giving you guys is going to cause you to vibrate on a different frequency. Okay. And on a personal level, if you are in my mentorship and you are not a profitable trader, guys, then I honestly don't know, because you've got everything that you will need, even the things that we discuss with myself. And, I'm telling you, okay, it doesn't necessarily obey structure, right? And there's a reason for that. Okay. So yes, at times it will obey, but I'll show you what gold normally does that gets people out, apart from just weakening people out. Okay, but let's go. Hence why I said that a study of a particular stock is very, very important. But let's go. So question number 1, why is there a reversal condition when it comes to NASDAQ in the middle of the month? Why is there a reversal condition when it comes to the market in the middle of the month? Okay, time. Now let's continue going. This is the 4th or to the 1st to the 4th of the new month. So this would be July. Okay, now watch this. This would be August. Now I want us to go ahead, and then I want us to go to the 1st of June. So we're going to look where the 1st of June is. And this is what we're going to mark. Okay. So here's the 1st. So this is 31st. There's the 1st of June. 1st of June is over there. Now I need you guys to watch this thing very, very carefully. Okay. 1st of June is normally there. My goodness. 1 June. Okay. Let me go to the previous month, and then we'll, I won't go all the way because of time. And let's go to this one over here. Let's go to the 1st of May. Here's the 1st of May. Okay. So we mark that 1 May. Maybe I can just perhaps do one more, and then we just go back, and then we mark this 2nd of April, which would be absolutely okay. I wouldn't really have too much of a problem with that. So I mark this as the 2nd, of April, or the 4th, 2nd. So where's April? Monday. So Sunday, Monday. So here's Monday. Okay. 2nd of April is on Sunday. So 3rd of April is on the Monday. Okay. So I mark that as my 3rd of April. Right over there. 1st, 2nd. So it's fine. I can mark it on the 3rd of April. Right. So this would be 03 April. Okay. Right. Let's continue moving. So what are we saying? Now, I want us to basically do a study. Okay. Towards the end of the month, from the 27th, 24th, 25th, there's an expansion in the market. Okay. Towards the close of the month, which is the expansion that we see from here all the way to here. This is an expansion. And this expansion that is happening in the market is happening towards the end of the month. Okay. Now, here's something that is very, very imperative and very important. Now, 2 things that I want you to watch. Now, this is what I said to you before, right? When we are seeing reversal conditions mid-month, okay, what the monthly chart will always do is that it will look at trading into, particular conditions, right? When it comes from the 1st to the last, to the 8th of the month. So let's have a look at this. 15th of the month is a reversal condition, as we have basically marked it over there. Okay. Now for this particular month, what happened here was this, right? We came and we traded into a fair value gap, which was this point over here, right? So that is a PD array, either fair value gap or essentially externally looking at order block ranges. Okay, so we traded into the 8-hour, okay, and I'm on the 8-hour here. So if I would go to lower time frames, you'd see what we're talking about even more to detail. Okay, so we traded into a PD array towards the end of the month, and we reversed here, reacted on a PD array that was created on the 15th of the month. Reversal condition for the trade was on the 15th of that particular month. Okay, so we had an expansion from the 28th to the 27th all the way to here, okay, which is a reversal condition. And then what we had is that we had a retracement down, okay, from the 1st all the way to 4th, 5th, 6th, 4th. So Sunday was here, and then Monday was basically over there, right? So we had a retracement down, okay, of which in our retracement that we had, what basically happened is that we came through, number one, we broke structure, and we also, because there was an order block over here where the market had already reacted upon, we just, came down and we came back exactly, to this particular point over here, which was a fair value again, right? Now, I want you to watch what I'm going to say, because this is very, very important. Now, I'm just going to mark this off for now. So what I need you to understand is there are expansions that happen in the market towards the end of the month. Now, this particular expansion that happens reacts upon a fair value, or it reacts upon a supply zone or an order block, okay? Now, this was very, very important. Now, the expansion happens, it comes back to what was created on the 15th, and then there's a retracement down from the 1st of the month all the way down to about let's see, all the way down to the 3rd. It came back, it went on the 3rd, on the 4th, it went up here, and then this was Friday, yes, at 10 a.m. It came to this particular level. Because we had broken structure, it came to retest on that particular structure. And then what did it do? It began to come down, from this. So this was just a reaction on a structural reference point, which then gave you entrance into what we call, that fair value over there, okay? So now this is how it would then connect when you are looking at the market from a structural reference point, and also then connecting, in terms of, your fair values. But we haven't actually discussed structure yet, but I want you to look at what basically happens in the market during specific times, because time of day is very critical when you are actually looking at your bias, or is very critical when you are looking at your narrative. Now, for someone who is a trend line trader, okay, someone could have just done this thing over here. So while the market had an open channel or a channel, okay, and then after the market had a channel, it then went up here, it created another channel, okay, and then what did it do? It created a double top instead of structure, and then, it broke this channel. So how they would have, maybe shaped, the idea of trading, from channels, was to say that when structure breaks over here and it comes back and it almost retests, this is where I would have taken my trade for a short, okay, and I would have maybe looked at essentially shorting over there, okay, at the break of this particular, structure, and come back to retest another structural reference point. And then this is where I would have basically shorted, okay? So then what a lot of people would do, they would come and then they would say, okay, cool. So if the market basically shorts over there, then maybe, they would essentially then deem, another trend line that is essentially going there at the bottom, which there is absolutely nothing wrong with that. Okay. That is essentially how you can build, your own bias. And then these guys would draw, these lines and where the market reacts, which is something that I'm going to also be sharing with you guys as an open idea. But just for now, I just want you to look at particular things that happen in the market and what happens during specific times of day, right? So here is the market meeting a reversal condition. It decides that it's going to change character by invalidating a low, which is essentially over here. Okay. And after it changes its character, right, which is over there, there's a bearish market structure shift. Okay. Because now this low has been taken out. Okay. So there was a stop rate there at the top. Because this low has been taken out, then now we understand that there is a market structure shift. So the market is now shifting sentiment to the downside because this low has been violated. Now that's what I talked about when I spoke to you guys about understanding divergence matrix. Okay. Because if this low has not yet been violated, the market could have maybe continued to offer higher high and high low. So it could have continued to go down, could have continued to essentially do this point. Okay. Now, guys, I want you to listen because I'm going to share with you even something. But when there's a structure shift like this, and then this law is now violated, then it gives you a reason why you should continue to go down. And most times, this is where you then see the foundation of a head and shoulder pattern, which is essentially over here. So there is always context behind your trading. Head and shoulder patterns, you don't just trade head and shoulder pattern just because of a head and shoulder pattern, but you want to trade head and shoulder patterns because of understanding the market structure shift sentiment in the market, where a previous low has essentially been violated. That is essentially what you essentially want to look at. Now, guys, listen to me very, very carefully. So month end, towards the end of the month, there's an expansion in the market. Now, that expansion in the market, on the first of the month, it will always trade into a PD array, like an order block or like a structural reference point that was essentially created within the market. Okay. Now, then what would basically happen is that after the expansion happens on the first of the month, it trades into a PD array. Now, because we understand that the first week of the market is likely a retracement into a particular level. Okay, it's likely a retracement into a particular level. So if there was an expansion towards the end of the month, from the first week of the month, the market will likely look at retracing back, okay, into where it essentially expanded from, right? Now watch this. So here is the expansion that was created during the last week of the month, and then we had a retracement that was created here during the first week of the month. Okay, so expansion, retracement, first week of the month, last week of the month, expansion, retracement. The expansion is expanding to this midpoint or this reversal condition that was essentially created when? On the 15th of the month. Okay, now I want us to basically hold this thought over here. Let's go to the previous month and let's watch what basically happened. Okay, so end of the month, from the 27th on year 26, there's the expansion. The expansion, boom, there's the expansion in the market all the way to the first of the month. Okay, now on the first of the month, there's a reversal condition. But where is the market reversing to on the first of the month? The market is reversing to this. What is this? This is a rejection block. What is this? This is a supply zone. So the market comes in and it gets into this supply zone here. Okay, where was the supply zone created? The supply zone was essentially created on the 15th. So for both of these months, we have exactly the same application of the same condition repeating on a series of 2 months. This one happened in July, and then this one happened in August. My goodness. My goodness. My goodness. So, second week of the month, what happens? Second or first week of the month, what happens? It's likely to be a retracement. Boom, time. Retracement. Okay, retracement. Where is the market retracing to? It is retracing to a PD array here, expansion over here. PD array happens. This is where the market is essentially retracing to. The market retraces back into this order block. Here, we invalidated this, which is totally fine, but we reacted upon this level over here, which was a structural reference point, right? But because the market was actually offering bearish sentiment, you can see that you don't want to actually go against the order flow of the market. So when you are trading, you also got to be cognizant of what is the order flow. So here, the order flow is still very much bearish. Boom, bearish order flow. This is still very much bearish order flow, right? So there is no change yet in market sentiment. Although this high was violated over here, now this gives you a perspective that the market is now changing its character towards from the downside all the way to the upside. Okay, but now the question is, when did the reversal condition basically happen? So while people are busy trading and they're trying to enter trades on a particular day, if you could have essentially looked at what happened in the market during this time, you'd have then understood that because it is the 18th of the month, we are looking for a reversal condition. Now listen to this. Now watch what I'm going to do, right? I'm going to delve onto my 5-minute time frame. And I want to delve into my 5-minute time frame. I'm going to come back to the 8-hour, but I want to delve into my 5-minute time frame. And delving into my 5-minute time frame, I want to go back to exactly where the market reversed, right? Which was over here. This is where the market met the reversal condition, right over here. Okay, now look at what I'm saying, because what I'm saying is then going to build a lot of context towards your trading idea. Now watch this. Now watch this. Now watch this. $10 a.m. Now watch this. 10 a.m. My God. My goodness. 10 a.m. 11 a.m. What did I say to you guys? What did I say? Every day, the market would look at running out internal range liquidity. From 10 to 11 a.m. New York time, it would meet a reversal condition. And this is a 5-minute time frame. Okay, so here we essentially create right over here on the 5-minute time frame. Okay, let me delve into the lower time frame. Let me go on to the 2-minute time frame. Let me go on to the 2-minute time frame. Let's look at this thing. Oh my goodness. My goodness. 2-minute time frame over here. What time is this thing happening? Between 10 and 11. What did I say? Between 10 and 11, wait for all this liquidity to be run out over here on the left-hand side of the chart. Now, what the market is going to want to do is that it's going to want to create an order block during this particular time. And then after it creates either an order block or fair value gap that you tap into, that is the trade that you basically take after all of that liquidity had been run out on the left-hand side. So when I entered this trade on Friday, this was my entry right over here on the Friday. Obviously, I didn't hold on to it long enough and I ended up exiting the trade. But this was my entry on the Friday right over here when we had tapped into this order block. So this was a sniper entry. Now, assuming that you had held on to the trade and I had held on to the trade, and because we understand weekly ranges, while everybody else is trying to get in over here and over there and over there, whatever it is they try to get in, because you understand what basically happens on a monthly narrative and on a monthly perspective, this is where you enter the trade, and it runs down all of this liquidity over here. Ran down this, and then it comes down and it runs down all of this liquidity there at the top, like it does on an every single day basis. This market goes all the way up to here. Now, this was about 550 pips from here all the way to here. Okay, this should have been about 477 pips. Okay, 477 pips. Consider that you had essentially held onto the trade. Now, isn't it interesting how the market, okay, did this very move during 10 to 11? So while other people are looking for head and shoulder patterns, and I saw head and shoulder pattern in my 8-hour, my 4-hour time frame, where would you have entered? The ideal condition for your entry would have been right over here at the bottom. Why? Because you understand reversal conditions that happen from the 15th of the month all the way to the 18th of the month. For you, that is how you build your narrative in terms of how these markets basically book. That is how you look at your idealistic perspectives. That is how you look at your own narratives. That is how you basically build your own ideas when it essentially comes to market sentiment. So entering a trade over here, riding it all the way to the top, which is over here. So I take out my ruler. Okay, I take out my ruler, and let's put this ruler here, and we measure from here, say, all the way to here. This was about 480 pips, 100%. So this is about 480 pips. Okay, and we also understand higher time frame narratives and methodologies when it comes to that. So do you guys now understand that time is critical? Time is everything. Yes, it's important to talk about structure. It's important to talk about those, and I'm going to talk about those things, right? How the market can essentially obey, trading patterns, whatever. But it's very important also to understand that particular things in the market don't just happen. It does not just happen. So for me, I want to build up your context. And now this is why I'm saying that I'm teaching you everything on this program so that you may be able to look at all these perspectives that all traders are using. There will not be a trader that you'll begin to look at and you will not know either the strategy that they're trading or you will not know what they are essentially trading. It's not going to be possible, more especially when it comes to you guys. Okay, so hence why I'm giving you this comprehensive, the way that it is, so that you can be able to build your own different narratives from what I'm saying. Now look at this, right? Now let's go back. Now let's look at what happens on the previous month. Okay, look at this. Look at this. Guys, I'm telling you, let's say from so this was 29th, 30th, 31st. So towards month end, there was an expansion in price. Exactly the same thing. Okay, exactly the same thing. So an expansion in price all the way to here. Okay. Now what the market does is that on the 1st of the month, it retraces. Okay. Now from the 1st to the 7th of the month, what is the market doing? Okay. So there's a retracement or there's an expansion, remember, right? And then there's a retracement from that expansion. Now, what's happening here is the same thing as what is happening here, but it's in inverse. So if I can just do Alt-I, I can basically show you this, right? So this is basically where we are. There's an expansion in the market, and this is the 1st of the month, okay? And then what happens? The market essentially goes down, and then here we meet a retracement condition. Okay, so here we're meeting a retracement condition from the 1st of the month all the way to the 6th or the 7th of the month, which basically happens every single time as well. Okay, and then when we tap into this, after the retracement, we tap into a PD array. Now, the PD array that we have tapped into here is a what? It is what we call either a supply zone, or this would also be framed as an OB, as how you look at the market, basically in this perspective. So if I turn this around again and I make it normal, okay, you would see that this condition that is happening over here is exactly the same as this condition that is happening here. It is exactly the same as this condition that is basically happening here. Now here, the reason why we've got some downside momentum was because we had a market structure shift to the downside. So if we basically put our trend line over there, okay, you can basically see that there was a market structure shift sentiment, to the downside, because these were violated, to the downside. So if this line, which acted as a support in brackets, was violated, then you would have essentially known that this would have been where you would have been retraced to expansion, and then the market just continued to offer what? Downward sentiment. Okay, so this is the same thing that happened over here. This is the same thing that happened over here. This is exactly the same thing that happened over here. So from the end of the month, there's an expansion downwards into the market. Okay, so let's look at what I'm actually going to be preaching, or what I'm actually going to be saying, because for me this is also powerful. And we could also take this expansion all the way from here if we wanted to, right? This could be an expansion. So this was from the 25th of May. So this is an expansion. End of the month, from the 25th, there's an expansion all the way to the 31st, right? Here, let's go back. There's an expansion all the way to the 31st. Here, let's go. There's an expansion all the way to the 31st. Let's go to the previous month. Here's the previous month. Towards the end of the month, there's an expansion all the way to the 31st. So Q, what are you saying to me? Okay. So do you mean that after every single end of the month, there's an expansion in the market? 100%. So then it puts you in a position to be able, okay, to anticipate moves that are likely to happen by understanding time of month. By understanding time of month, it gives you a narrative or where you're most likely to move off to. Now, you can clearly see, guys, you can clearly see this expansion at the end of the month. It's not accidental. That's why I said to you guys, okay, the day that we learn that the market does not move by accident, there are things that happen in the market based on time of day. But when you also understand that there are moves that happen in the market that don't happen due to accidental things that are basically happening in the market. Okay, so there are planned moves in the market. Now, I'm saying this, guys, this what I'm teaching you today is even apart from institutional numbers. It is apart from all of these things that I'm still going to teach you guys, extension, all of these things. This is just from understanding time of day during a monthly period. Once you begin to frame your ideas on that narrative, then you can start to say, let you delve into more detail, deeper detail. Can I tell you something? Some of the trades that I take are taken from these perspectives, because I know that the market is likely to retrace at the beginning of the month, which is what happened over here. A reversal condition beginning of the month, retracement up. Reversal condition at the beginning of the month, retracement down. Reversal condition at the beginning of the month. So you're telling me that on the 15th of the month, as well as the 1st of the month, we're likely to meet a reversal condition 100%. So reversal conditions will most likely trade into PD arrays. Now, if something like this was created at the beginning of the month, this was at the beginning of the month, what would you wait for? You would wait for a retracement that would take place in the first week of the month, because we created an order block. This was an order block, an expansion on the order block. I wait for a retracement. So you take a trade from here and you hold this trade all the way to the 15th of the next month. right? So you basically understand that this condition alone is a condition that you are most likely to tap into, because you understand that from the first to the first week, there's always going to be a retracement. The last week, there's always going to be an expansion. Mid-month, there's always going to be a reversal condition that happens in the market. Ish, guys. Must I stop? Must I stop now and go to sleep? Or do you want me to carry on, guys? My goodness. My goodness, my goodness, my goodness. Guys, listen to what I'm saying. This information that I'm telling you guys is something that would need you to go into your charts and would need you to basically look at for I don't know how long. Okay? It's not something that is shared most of the time, but I'm sure, and I don't blame people who don't share it, probably they don't know it. Okay? Now let's go. Let's go. Let's go. Let's look at this. Let's look at this, guys. Let's look at this. Ish, my goodness. Thank you, Father. Thank you, my Father. Thank you. Now look at this, guys. Expansion at the end of the month. Let's go here. From the 28th to the end of the month. Expansion by condition. Oh my goodness. Let's go to the previous, let's go to the first of, let's go to the first of, this was April. Let's go to the 1st of March. Let's go to the 1st of March. 1st of March, 2nd of March, boom. There it is. Exactly this thing that is happening over here, guys. Watch what happens. Watch it. Watch. My goodness. My goodness. Look at this. Look at this. Look at this. Hey, Shaya. Thank you. Watch this happening, guys. 1st of the month of March, an expansion to the downside. Okay, expansion to the downside. Reversal condition on the 1st of the month. First week of the month, let's start it from here. There's a retracement. First week of the month, there's this retracement. From here to here. Okay, you could say there's a retracement in the market. All right. Guys, this is building up your anticipatory skills, and the market doesn't really tap into this order block, but it taps into that order block, which is essentially fair to look at. So at this order block, but this is still relative and this is still relevant because weeks don't invalidate OBs. Okay, they don't invalidate OBs. Okay, we trade into that, and the deeper one would essentially be this one. So if we looked at high time frame perspective, it would make sense why the market would want to trade into this deeper OB. Okay, so exactly the same thing that is happening. Expansion. Okay, so the expansion towards the end of the month, a reversal condition on the 1st of the month. We expand higher. And what do? We look for a likely retracement lower. We tap into it after the first week, and then we continue to go higher. And this basically repeats in the market like clockwork. Same thing, 1st of the month, retracement, 1st week of the month. Then what do? We tap into a PD array, and this specific PD array we're tapping to is an order block. So this was the PD array that we were looking at, possibly tapping into right over there. Okay. So this can build your anticipatory skills. So what I'm saying is that you can use the same methodology that I'm using in terms of understanding the market from this time to this time. From 10 to 11, this is what happens. Internal range is taken, external range is taken. From 3 a.m. New York time to 4 a.m. New York time, the same thing happens. From 2 p.m. New York time to 3 p.m. New York time, the same thing happens. Okay, so then you can look at exploring your ideas from trading equities open, because equities open the market will likely trade into PD arrays like your order blocks. Okay, and I can show you the trade that I took. I was even live on Instagram today, and I took a trade with one of my mentees as well. That was at the office, but he came in and it came unexpectedly, so I just quickly helped him out quickly. Right. So this is one thing you can understand, guys. This model, right? This happened on the 1st of May. This happened on the 1st of April. Expansion towards the end of the month. Likely a retracement from that expansion at the beginning of the month. So the beginning of the month has a reversal condition as well. And then from the first few days of the month, after that expansion downwards, we are either likely to tap into a PD array, or we are either likely to tap into a structural reference points, of which we tapped into this particular structure over there. Okay, and if we are not tapping into structure, then we are definitely tapping into a PD array. Now let's move on to the next. All right, so here's one thing that you guys then need to begin to understand. Oh my goodness, guys, is this not too much information for today? Are you guys getting me? Because if you are, I'm going to be sharing with you something. If you are, so are you guys still understanding? Are you guys still getting it? Are you guys still flowing with me? Yes, not too much. Okay, let's get 111s. If you are ready for me to continue to share, let's get 111s on the comment section, guys. Let's get 111s on the comment section so that I can know. All right. Now, watch this, guys. Watch this, because this is still quite interesting, right? This is still quite interesting. Now, look at what happens over here. And I'm just talking about dates and times. So at the end of the month, the market is likely going to expand. Okay. Beginning of the month, first week, it's going to retrace. It's going to tap into a PD array like an order block after the first week of the month, and it's going to maybe continue expanding. If this low was not broken over here, remember, for it to change market sentiment, for the market to say that the structure has been changed, a previous low has to have been violated in the market, of which we would be looking at this low to be taken for us to say that there is a what? There is a market structure shift. This low to be taken for us to be convinced that there is a market structure shift to where? There's a market structure shift to the downside. Maybe there's a market structure shift all the way down here. Okay, and then going up. Now okay. Now let's look at this. First of the month, there's a reversal condition. 15th of the month, there's a reversal condition. The 15th of the month taps into this level that was created on the 1st of the month. Over here, just by looking at this particular trade. Okay, we're tapping into what? Something that was created on the 1st of the month, on the 15th of the month, which is something that I deem, actually to be very, very interesting. Okay, 15th of the month comes, there is a reversal condition, and then towards the end of the month, there's going to be an expansion. So this taps into a PD array. There's another reversal condition, obviously towards the end of the month, if we didn't see it. So from here, 26, this expansion is a reversal condition. Okay, so this expansion is a reversal condition, 27th. So we can denote that if Nasdaq continues, let's say it continues to go up. Okay, it continues to go up. For example, I'm just giving you an example, guys. Yeah, but towards the end of the month, there will be a reversal condition. Whatever reversal condition there is, either expanding to the downside, and then towards the 1st of the month, there will be a retracement. On the 1st week of the month, there will be a retracement in that particular direction, and then we might react to what we created there on the 1st of the month, which was maybe a PD array or something like that. So I did this, guys. I'm going to show you my chart. I did this even before the market got to this level last week, because I knew that the market would essentially meet a reversal condition. And this thing is a repetitive process. Every single month, the market repeats and it does the same thing. Why? Because of time perspectives, because of time narratives. So let's go here. Let's go all the way to February. February, this is the month of February. Okay, Thursday for 1st of February was essentially over here. Okay, you can understand perhaps why the market did something like this. This was the 1st of February. Okay, this was the 1st of February. And guess what? The 1st of February, there is a reversal condition that happens in the market. Then the market on the 15th taps into a level that was created on the 1st of February, right over there, because the 15th is also a reversal condition. Now there's expansion downwards, and then we tap here. So almost zero drawdown on this particular level over here. So 1st of the month, a retracement, it retraces into this structural reference point because of our structure. So when it retraces, we always look at it retracing into structure or retracing into OB. But on this level, it retraced into a structure, and then it obviously, you know, came down to this 1st of the month, retraced back into an order block, you know, went up, and then it does the same thing. It is a repetitive process, guys. During time of the month, there are certain moves that basically repeat. Now, here's what I'm going to say, right? And I'm going to say that, you know, for those that have ears, let those that have ears begin to hear very well. Okay. Now listen to me, guys. And I want you to listen to me very, very carefully. The only time you enter trades from structure, okay, is when you have run down internal range liquidity. That is the only time. And you are looking at running down external. So if you've got a low resistance liquidity run, that is where you enter trades from structure. Now, if you want to take trades the way that myself take trades, the way that Caleb take trades, I'm going to give you a very big secret. What we basically do is this, okay? A lot of times, and this is some things that people don't know, and I'm sure that Caleb would never really tell people this, but you guys are my mentees. So I want you to get the best kind of education. So I'm going to tell you this thing. Listen to this. The only time you enter trades on structure is when, oh my word. Guys, are you ready? My goodness. My goodness. Okay. The only time you enter trades on structure, okay, is when there is a low resistance liquidity run. This is a secret, ne? Now, when you begin to enter trades like myself and Caleb, and don't now begin to say that, hey, guys, you see, I'm better than these ones. Yeah, I know you guys. I'm just joking. Listen, guys, this is a low resistance liquidity run. High resistance liquidity run is over here like this. This is pure structure, higher highs, higher lows. The only time you enter trades in structure, as you guys see it over here, this is structure. This is an uptrend. This is structure. This is structure. This is structure. But now what you need to understand is that the reason why you don't want to use structure as your sole point of entry is that in structure, there is likely to be a drawdown. And that drawdown is likely to tap into maybe an order block or an area of institutional perspective. Okay, so there's likely to be a drawdown when you enter trades on structural reference point, unless maybe you are entering from OBs, right? So when you are essentially look at structure, you don't use structure to basically enter trades. You can use structure to enter trades when you've essentially got a low resistance liquidity run, because after low resistance liquidity runs, we normally find high resistance liquidity runs, as I've explained to you guys. So the objective is not really to enter trades on structure, but the objective is to enter trades, okay, in the market when the market essentially gets to either an institutional level or it gets to the extension of that institutional level with an order block on that on that institutional level. So here's what I'm talking about. If you have got your chart over here like this, and you have got your candle, right? And you have got your candle like this. Confirmation of a buy entry, okay? Now, this is for the ones that are deeper in understanding. If you don't get this, don't worry. We are going to get to it, okay? If you are not yet there, don't worry. You are going to get there eventually. Assuming that this is a green candle. Hey, guys. Let's see, guys. Let's see the fire emojis, guys. Let's see the fire emojis. Let's see the fire emojis. Energy, guys. I want energy, 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 energy. I'm showing you market mysteries, guys. I'm showing you mysteries. Look at this thing. Look at this, guys. Assuming that this is your candle, okay? You understand as my mentees that you've got a high over here. You've got a low, or sorry, you've got a close of the candle because it's a bullish candle. You have got a low, sorry, you've got an open of the candle, and then you've got a low of this candle. Now, here's what happens. If you have got this on a daily time frame, okay, this one here would be extension. Now, I'll tell you why we've called it that, and this too is extension. But that's for tomorrow's lesson, not for today's lesson. Now, this is where you would essentially find your confirmation of a buy entry or confirmation of a sell entry model. Now, on your daily time frame, the market will always move around either the open, the low, the high, the close. That is why we said that there is a lot of power in OHLC values. So here's what we do, okay? So what we do is that we wait for the market to come into the extension of the candle. Why? Because most likely the market is likely to either from this level react and create a buy scenario, or from this level go to extension 1, extension 2, extension 3, blah, 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 blah. So what you want to do, more especially if you are looking for long-term setups, you can actually do this thing even on a monthly time frame. Are you guys listening? When you do this on a monthly time frame, you can be able to hold a trade for a whole month. So what you want to do is that if you are on the monthly candle and this is what you identify, the minute, my goodness. Father, help me. The minute the market comes to this extension, okay? And what it basically does is that from this particular extension, it creates an OB. Are you guys listening? Energy, guys. Are you guys listening? Yes, no, yes, no. Okay. From this particular one extension, it creates an OB. So what you need to look at is OBs, so this would be the order block over here, assuming that this is my order block. Okay. Now, this is an OB. Oh my goodness. Now, OBs with extensions normally don't have drawdown in the market, because what the market is always going to want to do is, if it comes from a low, because we understand OHLC values, it will come from this and it will move all the way to this. And it can, you can even hold your trade for a month because the market does this thing. So this would be the first, obviously, extension that we're talking about. So if you want to enter trades like how we basically enter them, you can enter them at 3:30, 2:30, whatever. It does not matter, right? Equity is open, it's fine. As long as during that time you have actually are on the extension, there was an expansion of an order block, and maybe assuming that this is the monthly time frame, because this is where your candles are essentially going to operate. Okay. Now I want you to basically watch what's going to happen over here. We're going to talk extension +1, extension +2, and all of these things. Maybe I'm going to explain to you guys about BMS and all of these things. Okay. There are some people on social media that are going to begin to ask, hey, how are these guys? Where are these guys from? How on earth are these guys doing this thing? This is what we do, guys. I'm showing you now in-house secrets because you are my mentees and I love you guys. And I love you, and I can't keep information that is this important away from you. Now that you understand time, watch this. Okay, watch. Okay, let me open up another chart of NES and let me make it more clearer. My goodness. Let me open up another chart of NES. Let me open it up here. Okay. You see, this is the trade that I took, guys. Also early this year. But let's go. Let's forget about that. Oh my goodness. Extension. I hope you guys are seeing what I'm doing. All right, let's get it. Boom. Are you guys seeing what I'm doing? Extension, institutional number high, extension, institutional number. This is an extension 2, institutional number low. Most likely, we will trade into this level, right? Now look at this. Okay, I want to show you guys something. Mystery, right? Now watch. Now, whenever we look at external ranges in the market, okay, what basically happens is that from an objective of monthly range, it will always move from one extension to the other before there's a reaction there. You guys get it? All right. So watch. Boom. Okay. So are you guys listening, right? So this was on a 4-hour time frame. Okay. Now look at where the reversal condition basically happened. The reversal condition happened 1st of August was over here. 1st of August was there. 2, not only is this the 1st of August, this basically traded into a specific level. Magnet. Let me remove this. This was on the 4-hour, right? So it traded into the extension. And after it traded into this extension, this is a trade that you would have possibly looked at holding for about a month because it would have moved from one extension to another extension. Now, depending on the candlesticks that you have, you could have extension 1, extension 2, extension 3, so forth. Okay. On the monthly range, but this is just extension 1 that I'm showing you. So if you had essentially taken your trade and you placed your sell order from here to here, this would have been 590 pips. Holding the trade, your TP would have been here, and you would have held onto the trade for about a whole month. So what I'm saying is that if you are in trades, okay, and you basically hold on, and you basically use this, methodology, okay, you could essentially hold your trades for about a whole month, right? Just by understanding. So how we basically do it is just through these models, okay? How we basically take the trade is just through this model. Now, let's assume that you understand the narrative of time, okay? Let's assume that you understand the narrative of time and you also understand the narrative of dates. Now you can see, guys, that this kind of entry that you would normally have over here, okay, and this entry happened at 2 p.m. South African time and New York time, which is between 8 and 9, right, which is very, very fair. So if you scroll down then to the lower time frames, you could essentially get a better idealistic entry model, for this particular kind of trade that you would be looking, provided that you traded, there was an order block that was created in the market, and then you came and then you traded into this order block. So this was 1 hour. Okay, you are on this extension. Let's go to 15 minutes. And you can see that because the market had essentially taken off this high, then invalidated that high, it did not need to create, it didn't need to essentially break this particular high over there. Okay, so this was actually on the 15-minute time frame. Let me just quickly scroll down and go down to my lower time frames on the extension, on the particular extensions, right? So on this one, on the 5-minute time frame, this is why I like the 5-minute time frames, because they give you a more deeper, a more, better entry model, right? And this would have been either here, because this was month end, and on the 1st of the month, this clarifies it even much more here. Okay, so for a model specific entry on detail, because you understand that you're arranging on this particular extension, the market comes there. This could have been used as an entry perspective, where the market comes back into this order block. Okay, that was essentially created from this time, and then it tapped into this time, because this was the 31st of July, so towards the end of the month. And then the end of the month, you also had on the 1st, because we know that first are normally reversal conditions, you also had an opportunity to get in on the 1st over there. Okay, so
what I'm basically alluding to, guys, here is that you have essentially got deadly information that can change a lot of things. Okay, so understanding dates, understanding time, understanding perspectives in the market basically puts you in a position to be able to change your whole life forever, guys. That would have been the entry for this particular trade if I was looking at lower time frame perspectives. And possibly because it happened at 9:55, say 9:30 US time, which was very relevant, it would also come in and understanding my time that I normally trade from 10 to 11. This would have also been a very, very, good entry model. Okay. So from the 31st, start looking for reversal conditions until the 1st. Now, because you're in an extension, then you understand. So because we normally, when you're looking at these strategies, we normally trade 3:30, for example, 9:30, this, or 9:30 to 10, more specifically 9:30, tapping into an order block. This is an entry that we would have considered, entering. And this is a trade that you could have held on to for a whole month, because it was in the extension, and you hold on to it up until it begins to hit this. August, July, 8th of August. This was basically Monday, 31st of July, 2023. So this was July to August. And the same thing happened for May to July. And it's just a repetitive process, guys. That is how it's done. That is how it is done. Okay? And I'm done for today. I'm done for today, guys. Market mysteries. My goodness. Market mysteries, guys. This is how we book. This is how we begin to enter in the markets. And some people are like, how the hell are you guys doing this thing? No, this is how we basically do it. This is how we basically do it. So there is no need for anyone over here to enter a trade Okay. There's no need for anyone over here. You see, this would have been one trade that would have made you over 500 pips. Just one. And you took it at the end of the month because you understand reversal conditions that basically happen in the month. You are sorted. You are sorted. And this is it, guys. Yeah, this is it. So let's get the 5 emojis running. If you guys have got any questions, you may actually ask me of the questions that you have. And then let's go. This leader's phone is it's vibrating, or I don't know what it's doing. All right. Pompito, no, it's too late now, guys. We've been pushing for 2 hours. I will say something on gold on our next session, not today. I just want to take questions today specific to the subject matter. All right, Pompito, you can actually unmute yourself. Yes, Pompito.
Yes, can you hear me? Can I ask?
I can hear you, my brother. I can hear you, my king. Yes, Pompito.
Yes, because you mentioned between 10 and 11 that usually that is an optimum time to actually enter. But then is that on specific dates as you mentioned, or is that based also on the fair value gaps?
No, it's not based on specific dates. You can essentially use every single, like you can trade this on an every single day basis. So one of my strategies that I use are this particular strategy where I look at entry model from 10 to 11. Why I look at that is because I've gotten rid of the volume that was happening during equities open. So I already know what the market has done in equities open. And so I already know what I can anticipate during 4 and 5 or 10 and 11, which is obviously a reversal condition, between that time. So if in equities we traded down, I can start looking for reversal conditions. Given the fact that higher time frame bias or higher time frame PDRAs, like for example, an order block, that's where the market is likely to run off to. So during my obviously this strategy, I love looking at weekly bias in terms of what is my direction on the weekly range. So where am I likely to tap into? Am I likely to tap into a fair value gap? Am I likely to tap into order block, or whatever the case may be? And then what I want to do during the 10 and 11 a.m. time, I want to wait for liquidity to be run out. So I want to wait for price to either move down, expand down, and take out all the other sell side liquidity, or take out all the other liquidity on the left hand side of my chart, which were lows that were created in the chart, run out those lows and then meet a reversal condition. So a lot of times your reversal condition is always going to be met from 10 to 11. Why? Because you've gotten ahead of the news, and as well as you've also obviously gotten ahead of the equities open as well. Okay, so that's why I consider looking at that time, because there's a lot of volume between 2 and 5. So if I enter between 4 and 5, I'm entering on the last hour of the 2 and 5 session, which is where I would normally execute. Okay, according to people that trade smart money ideologies, they call it kill zones, or a kill zone. So a kill zone would be from 2 to 5, because that is where there's a lot of volume in the market, because that is also a level where the London session and the New York session are both open at the same time and they're active. So between 2 and 5, that's when the market, really, generates a lot of liquidity and generates a lot of volume. So at times, if I'm not trading at 3:30, I want to look at trading between the 4 to 5 window, because I know that during that time, it will create an institutional idea, which is like an order block, and it will still trade into that order block during the time, and then it will move in an opposite direction. If it does not trade it during that time, it will trade maybe into a fair value gap, depending on what the order flow is. Obviously, if the market hasn't broken a previous high, and if we are going down, then my order flow would still be bearish. So if my order flow is still bearish and there's no high that is violated, then I would expect, some form of continuing with the downside momentum of order flow, until I see that on my lower time frame, I've at least changed character, I've at least shifted structure in my market. Then that's when I would say, okay, a high has been violated. Now let me wait for the market to reprice back into my order block, and I can essentially go for longs. Why? Because it then gives me an idea that now, because the previous high had been taken, now we are likely to continue expanding higher. But if no high is taken, then we're not likely to expand higher. So what I'm just trying to say is that time is, you can look at that trading time on an every single day basis. It does not have to be on the month end, or on the 21st to the 30th, or maybe on the on the first of the month, or on the mid-month, on the 15th of the month. It does not have to be that time. Okay, it can be on an every single day basis, because this move happens every single day in the market and it repeats. But you get so much power when you enter on those dates. When you enter on the 1st of the month, you enter end of the first week, you enter on the 15th of the month, and maybe you can consider looking at entering from the 26th upwards, because there's an expansion in price in the market that basically takes, that basically happens at that particular time. So you'd find that you don't need to trade the whole month. There can be a lot of days where you don't trade, but you only trade where you're anticipating some form of reversal condition that happens during times of the month that is likely to give you like 300, 400, or 500 pips. So you could find that at the end of the month, you're sitting on 2,000 pips. And now that makes you the difference from someone who's just day trading or trading every single day, because day trading is not trading every single day. Now, our problem as day traders is that we want to look for trades every single day, but that's not what day trading is. Day trading is not trading every single day. And sometimes we want to get in the market because there are probable setups that we think are there, and we end up burning ourselves. Now, wouldn't it be easier if you were to understand time of day, you understand time of month, and then you were to understand what I was telling you guys about extension and about trading into an order block from that extension? Then it just makes your life easier. So you're not trading from structure, but you're trading from order blocks, because structure, they've got the possibility of drawdown. But when you are trading from extensions during certain times of the month, like end of the month, then you are most likely not to encounter drawdown, especially when the market taps into your area of order block. So these don't necessarily have a lot of drawdown. Whereas if you're just trading every day, just looking for a setup just because you want to trade and make money, then that's not what you are looking for in the market. You want to look for the most probable trades with the highest rewards. Now it fixes your psychology and it puts you in a better level as a trader as well.
Okay, I see. No, thank you so much. And just a note of what sort of confluence can we be looking for between 10 and 11, because we are obviously anticipating some kind of reversal. Is there a certain confluence perhaps that we can look on, or should we just focus more on order blocks and so on?
So there are a lot of confluences that you can basically look onto the market. Remember, there are what we call as measured moves. Okay.
Yes.
So they're what we call measured moves in the market. Now, there's something that I'd always been explaining, that Nasdaq has got measured moves, US30 has got measured moves, Euro USD, gold, all of these things that we trade, they've got measured moves. They call it standard deviation. So all of them have got their own standard deviation. So Nasdaq, for example, moves by 250 points. So a lot of times, and then there's an institutional number of Nasdaq 200. So a lot of times Nasdaq would want to get to certain maybe institutional reference points. For example, like 200, which is an institutional a number or level, or maybe 800 or maybe 500, or the flat level. So that could be used as confluence. There's a lot of other confluences that you can essentially use. What are the range moves in the market? What is the fib, saying, are you in a premium? Are you in a discounted level? So there are quite a bit of confluences that you can use in the market. But I know, because you're relatively new, these are some of the things that you will use. But I really want to make sure that I share this session with you guys, and perhaps tomorrow's session, and then after that I can send you guys a PDF journal or guide that will actually help you to take trades at have a trading plan that you can basically use, what you need to look out for specifically when you are going to be entering the market.
All right. Okay. Thank you so much.
Cool,
That's
brother.
all. Okay.
Lovely. All right, let's get the next person. Thank you, my mentor. Thank you, Mama Fungashe. Really appreciate it. All right. Yes, King Nosi, go ahead, my brother.
Yes, I've noticed that you mostly use the 8-hour time frame. How does it fare compared to the normal ones in method traders?
Okay. Look, there is no I know that that's what we normally say, because that's what we accustomed to, that's what we're used to, but there is no normal time frame. You've got to swift all through time frames to know what is happening through all of the time frames. So obviously, sometimes I would use the 8-hour time frame because it has got a higher time frame bias than the 4-hour, but it's got a lower time frame bias than the daily. So you'd find that at sometimes things that from a daily perspective that maybe I would have liked to see, I would see them on the 8-hour. Okay, so if I see a conference on the 8-hour, there's not be a point of interest on the 8-hour, then there wouldn't really be a need for me to tap into the 4-hour. Okay, so you've got to swift through all of time frames, because all of these time frames tell something that is different. Now, that's why I was saying that before, that the market in its nature, it's fractal. It's got a fractal structure. So there's not actually a big difference between the 8-hour, the 4-hour chart, because the 4-hour has just got a bit more volume than the 8-hour chart. And it's the same thing when we are looking at trading, this idea that I'm essentially giving, because if you've got, say, you've identified an order block on the 5-minute, or identify a fair value gap on the 5-minute, there's no need for you to go and look for a fair value gap on the 1-minute time frame. Because a lot of times what I've seen in the market is that if I'm just solely focused on the 1-minute time frame, it's possible that the market can tap into my 3-minute order block and then leave me and then go without me, right? Now, for me personally, a lot of times if the market does not, if I don't enter where I should enter, I normally just leave it. Okay, or maybe sometimes if I identify another order block during the time, then I'll maybe, but I never want to enter in the middle of a trend. I always want to enter when the trend is starting. So that's where I look at. So for me, it's like the reason why you want to, so if you've got an order block, 5-minute order block, you don't then need to go and look for really necessarily find a 1-minute order block for the market to tap into, because the 5-minute order block it tells a story of what is likely to happen in the market. So as well as the 3-minute order block, it's the same thing. So what I'm just trying to say is market is fractal. So a lot of people would use the 4-hour, and I also use the 4-hour, but in terms of how the market is, you can use any time frame. You can use even the 10-hour time frame. You can use the 9-hour time frame. You can use the 7-hour time frame. It depends on what you look at. But I like looking at the 8-hour because I love using the 4-hour time frame. But the 8-hour is just a higher time frame perspective than the 4-hour, but it's a lower time frame perspective than the daily. So it's able to at least give me a bit of sense in terms of what is going on between the daily frame and the 4-hour frame, because it's right there in the middle. So you can actually swift. There's not much difference, but you can actually swift through these different time frames because they depict a different story. All I'm just trying to do is find higher time frame bias. And if I don't find it on my 4-hour, I'm likely to find it on my 8-hour. Okay. Or if I don't find it on my 8-hour, I'm likely to find it on my 4-hour. That's why I use that time frame. All right, cool. So King Nosi gets it. All right, let's get other guys asking the questions. Any questions, guys? Any questions? Any questions? Any questions? Any questions? Any questions, people? All right.
No answer.
All right. Yes, sir. Go ahead.
Yes, can you say something on the low and the high resistance? I find it a bit confusing. Just
Okay, I am coming just now. Just give me a second. All right. Talk to me, sir. Let's go again. What's the question?
okay. I was saying, can you say something on the low and the high resistance? I think I find it a bit confusing. Can
Can
you
I
say
say something
something
about the high
the
resistance and
the
the low
low and
resistance
the high
liquidity run?
resistance? Yes, please.
That's what we're talking about, right?
Yes,
Okay.
please.
Okay. Remember what we said. So you want me to talk about the liquidity runs? Is that what you want me to talk about? Yeah. So let's look at
Correct, sir.
hey. Okay. I just want to make a very simple example that you'll be able to find. So here's a simple example. This one is easy. Okay, you see what is happening over here. So when we are talking about low resistance and high resistance liquidity runs, we are talking about expansions in price where there's a displacement in the market. Okay. Just let me just see. All right. So let's see. So here's what we're talking about, my king, right? So when we're talking about low resistance, this here is an expansion in price to the downside. Okay. So what happens is that the market is just expanding, to the downside in price, right? And then what would happen is that a lot of times when you just see an expansion leaving a void in liquidity, what basically would happen is that when the market comes back up, a lot of times, obviously it doesn't happen every time, but a lot of times this is basically what you see. So this would be low resistance because there's an expansion in price to the downside. And then essentially what would happen is that after the expansion, the market would then want to come back and would want to create a structural reference point. Now, this is why we say that you never really want to take your first trades on structure. You can only use structure. If you want to get sniper entries, you use sniper entries on extensions with order blocks. Do you understand? So if an extension has got an order block, then that will give you a very sniper entry with almost zero drawdown. But these structural reference point structures have got drawdown basically. Do you see what I'm saying? So for example, this is a low resistance liquidity run that we're basically seeing over here. So there's an expansion of price to the downside. So price does this. This is an expansion of price to the downside. But what happens when price goes up? Now this is high resistance. So this is what it does. It goes up, it comes down, it goes up, it comes down there. It goes up there, it comes down there, it goes up there, it comes down there, it goes up. So all of this is high resistance. So compared to this over here, this was low resistance, but then when it went up higher, it gave us high resistance liquidity runs. Do you see? So this was high resistance. But when you got high resistance, that basically means that after low resistance, then you can get high resistance liquidity runs that will enable you to basically take trades on the retest of structure. So it's like a break and retest, in terms of structure of the market, right? But at times, structure is also, because structure is able to give you drawdowns in the market at times. So you see these wicks are drawdown. So you must be, when you do consider entering on structure, then it's a point of consideration when you want to basically look at what you call this thing. When you do enter on structure, it's a point of consideration just to make sure that, when you do enter, you have another additional confluence, for your entry, because you'd find that in structure, there's a lot of drawdown that basically happens. So you consider this as structure. The market comes, you see, this is drawdown. It goes up and comes back down to this level and doesn't respect this level. That's drawdown. The wick is drawdown. It can actually wick you out sometimes. And then, here was basically tapping into an order block or something. So the more safer levels to look at is the market tapping into like a OP or something like that. And that would obviously build a referential point or idea. Okay, so this would be low resistance because of expansion down, and then when you go back up again, this would be high resistance liquidity run. Okay.
Thank you, my king.
All right, sir. No problem at all. All right. Guys, I'm not sure if I've got any other questions. If I do, let's.
Sorry, just one last one.
Yes, Bombito, then we give to D. Go ahead.
Yes, I wanted to just ask, because you obviously mentioned that one of the reversals happens in the middle of the month, but is there a way to specifically identify on which specific day it actually occurs, or it's just a general between that time or those days after the 15th?
Very beautiful question. So a lot of times it would happen between Wednesday, Thursday, or Friday. A lot of times. So let's just do this. And also considering the fact that when you look at that, you want to look at, has liquidity been run out, on the left hand side of the chart. So let me let's just do a physical thing over here so that we can just get to run this thing down. So maybe let me create this. Okay, cool. So let's have a look at this. Let's have a look at this. All right. So a lot of times when there are mid-month reversals, they begin to happen on a lot of times it's on Wednesday, Thursdays, or Fridays, essentially. But what you've got to wait for is at least a confirmation in terms of your higher time frame bias. That's why I'm saying higher time frame bias is very important, because one of these 3 days, right? Because I'm on the 4-hour time frame, but where is my higher time frame narrative? So what am I likely to tap into a higher time frame perspective? You see that this is here, this is a 4-hour structural reference, and this is where the market basically turned around. If I'm to put it, it ran down all of this liquidity over here. Okay, so it ran down all of this liquidity over here, and then what did it do? It then came back to this structural reference, which was also structure. So this was actually structure, but this was an order block. So it was retesting it came back and retested our break. So the market came and retested this particular break, and that's where it turned around. This was the breaker. Breaker is normally an order block that was violated, and you can see because of this expansion downwards, it creates an order block, and we come back, we trade from that expansion to the upside. Do you see, right? And then we come back into this, and now this happens mid-month. Now, if I'm going to open up my this was my 4-hour chart. Now let's basically see if we've got any confirmation on the 8 hour, and on the 8 hour, it's still the very same thing, eh? So the 8 hour, this is the breaker that was created, and you can see, and this is from a structural reference and expansion upwards. So this creates, you know, because there's an expansion upwards from this creates like an order block, basically, which is from here, or a demand zone that we have, right? Because we had this market coming down and an expansion upwards. So this was coming, tapping into a higher time frame, you know, demand zone, basically what we saw. Now let's look at the dates. So higher time frame perspective was managed. Our only problem that we have as traders is that we don't want to, it's hard for us to be patient, because we think that if the market leaves us, we are not making money on that day. And you'd find that if you just were to wait for the market to do its thing, then like you would make far more money, you know, just by being patient. This is why someone once said that if traders were to learn to sit on their hands 50% of the time, they would make a lot more money. So the sad reality is that a lot of traders want to always be in the market, and they always want to enter, and they just don't want to be. That's where patience comes in. I don't trade every day at times. Caleb doesn't trade every day. Maybe we'll trade once or twice a week. So sometimes, you know, unless maybe he wants to give out a signal, but his personal trades, he can put out a signal, but people say take the signal, but he doesn't take it personally because it doesn't meet his requirements in terms of higher time frame objectives. So this is what a lot of pro traders would also do. So for me, let's look at the date. Now look at this condition. When did this happen? It happened on the Friday, isn't it?
Yeah, on a Friday.
Okay. When did this happen?
On Wednesday.
Okay. When did this happen?
Yeah, Friday.
Okay. When did this happen?
Thursday.
Okay. So mostly it happens on a Wednesday, Thursday, Friday. Does happen Tuesdays, but very rarely does it happen, because yeah, we could say that. So we could actually put it. So this was Tuesday, but then it actually tapped into this order block on the Wednesday. Do you understand? So so this was the Tuesday, but then it tapped into this order block on the Wednesday. So that happened on Wednesday. When did this happen? It happened on Wednesday. So you look at obviously Wednesday, Thursday, Friday, most of the time in the market. That's basically where you would see these reversal conditions. There's another one. When did this happen?
Thursday.
Thursday, exactly. So Wednesday, Thursday, Friday, there are specifics, you know, to that in the market. And this is why I said that a lot of people think that, no, this is just a coincidence. There's no coincidences in price. The market wants to do two things. It either wants to move to a level of liquidity, which is a previous low or previous high. So it wants to invalidate these highs or lows. So this is a low. So that's what the market wants to do. That's a low. So it either wants to invalidate the lows. So this is a low. Or wants to rebalance, you know, imbalances in the market. So you always want to look at rebalancing imbalances or chasing previous highs or lows in terms of buy side or sell side. So imbalance, rebalanced over there. That's what the market will always want to do: rebalance imbalances, or to run out, you know, previous stops or previous lows in the market, and then for it to meet a reversal condition. So again, from SMC guys, this would be what we call a turtle soup condition, a turtle soup or a reversal manipulation condition, basically, where the market goes down and it rounds out liquidity, and then it turns around. So this would be a turtle soup condition. This also here would be a turtle soup condition over there. Okay. So it runs out, and then it changes direction from your stop. All right. So yeah, so it happens on Thursdays most of the time, my brother. Okay, cool. Let's move on to D. Is D still here? Oh no, she's not here. Okay, I think she is here. She is here. D. Hello, mommy.
Yes. Hello.
Yes. How are you?
I'm okay. I'm okay, I guess.
Blessed. Talk to me.
Yes. I want to confirm something.
Go ahead, ma'am.
We said that from 9, and then between 9:30 and 10:30, the market will create, the high and the low of the day. And around 10, the market will do the reversal, right?
Most of the time, 100%. Absolutely.
Okay.
Absolutely.
Okay.
During the New
Okay.
York session. Mhm.
During the New York session, yes.
Yes.
And then around 11 or before 11, the market will create an order block. And then because I've actually I've been observing around 11, the market will continue with the direction of the day. And the reversal
Mhm.
that happened around 10, it's like a pullback. It's not a long like a reversal, because now when I check from around the 20th, even yesterday, it's like the reversal is like a pullback. But around 11, that's when the market will actually, continue with the trend of the day, I guess. Am I
Beautiful.
right?
So here's what happens, right? That's actually a very beautiful point of analysis. Okay. So at times during, and that's why I was saying, like, if you understand daily order flow, or you understand order flow in the market, it would be it's something that is very, very like important, because once you understand order flow, then it changes everything for you, right? So on these particular conditions, right, what you are most likely to see in the market is the market creating a PD array and then trading back into that PD array. And when it does trade back into that PD array, it either comes through a reversal condition, or it trades into that previous PD array, and then it goes according to the direction of the day. So this is highly dependent on the bias, right, of the day. Now, if you look at the chart over here, okay, now this internal range liquidity has been run out, fair enough, but there's still liquidity here and here and here in the form of equal lows. So what the market then wanted to do over there was to come and to likely take off these levels, because when you've got relatively equal lows, that's like a strong level of support. So that's a clean level. So once you see a clean level of support, the market will always want to come back and at least stop out these people, so that people who actually put buy stops here at the bottom, the market would normally stop them out and then move in the opposite direction, when it comes to clean levels. But when you are looking at this now, there are so many scenarios where you'd find that the market, instead of, when it does run out all the liquidity that you can possibly notice, on your lower time frame bias, it would normally run out, and then it would continue to go up the day, and then running out all of this from this particular reversal condition that will basically happen over there. But the bias that was created, I think from 230, was that we are moving in a downward movement. So you don't necessarily want to move against the overall bias in the market, unless there's liquidity that has been run out that is easily identifiable on the left hand side of the chart, right? So here, okay, the bias was still relatively negative because we had taken out a stop. So this was a stop hunt at 2:30, 3:30, 9:30. We traded into an area of an order block or something along those nature, and then we traded back down. Okay, so this condition over here, let's look at it from the 3-minute time frame, and then we'll go to the 2-minute, and we'll go to the 1. So here I actually had someone that placed a trade over here, which was the mentee of mine put the trade over here. Okay, so we placed the trade over here and we bought. So initially, okay, and now you can basically look at this because it's very, very important. Initially, this tapped into this order block, and then there was an expansion to the upside in the market. So if I can take the market from here, so this was about 70 pips. Okay, so he got about 70 pips, but so that reversal condition gave him 70 pips. Now 70 pips is actually a lot of money in the market. So this is why I want people to say that even if you've got a condition that has a reversal, 70 pips can make you a hectic amount of money. You don't need to obviously look at hitting the home run the first time. But again, over here, because the daily order flow or the order flow was generally, it was bearish. You can basically see it was a bearish order flow. So what you would obviously expect from a bearish order flow, and remember here we had an area of support, right? Which created almost like your equal highs, but there was not the market didn't close above this area over here. So it didn't close above this area over here. So obviously, you know, you would have anticipated some downward move, unless maybe we had expanded further. So you've only got between 10 and 11 to essentially enter the market at this point. And here you basically had a very beautiful order block, okay, to the downside. And so you could have either taken this trade and then continued about the flow of the day. Okay, so understanding daily order flow is actually very, very important. But I love the observation. You see, this created a very nice structural pattern, and then it just began to go down over there. And then let's take maybe between 9:30, which was essentially over here. So 9:30 is over there, and then 10:30 is over 10:30 is essentially over here. Do you see now? So for this particular session, we had created our high of the day. Okay, so if I would basically delete this thing over here, and then I'll delete this one over here, then I'll delete this one over here just for purposes. Okay, so what you basically find is that we had created our high of this particular session, right, which was 9:30 was 9:30, 10:30. So for the New York session, this was the high for the New York session, high of the day for the New York session. Okay, so we're likely maybe not to invalidate that high, but if we did, maybe we're going to trade into it, and then we're going to continue to come down. But instead, we traded into this order block, and then we continued. So this high of the day, basically for this session, was likely created between 9:30 and 10:30, but you also had another high that you basically had over here, which was at let's see, so 8 o'clock. So let's say it was at about 8:30, right? So we had a high there at 8:30. And then what basically happened over there is that between 9:30 and 10:30, you also created, that specific high. So over here during this time window, this is where you mostly anticipate for you to get either the high or the low of the day. Sometimes it could occur that you have a condition such as this, where it's created before this time window. But a lot of times, majority of the times, the high of the day on the New York session specifically would be created during 9:30 and 10:30 window. Okay, but sometimes you do meet reversal, you do meet conditions where it's not created at that exact time. Maybe it might be created before the time, and then the market might trade off from that time. But then that would also create a specific high that you can actually then denote your market from, because now you understand, okay, the order flow is generally bearish order flow, and they've got a lot of structural reference points over here, because here is just a reaction to structure. You see, this was like a high demand zone expansion, and the market tapped into the T to this level because this is just a reaction to a structural reference point. But also you've got, your order block over here, which also then begins to make sense. So these were just two confluences that you've got structural reference points from this expansion. So this is a breaker, and then you've also got another order block over there. So you anticipate your skills are obviously built towards, the continuation, of this particular day, which happens to be very interesting. But this is a trade from this reversal condition. This is a trade that you could have taken. So this particular pullback is actually 70 pips. Okay. And then this move from this particular pullback over here, let's see how many it is. So it's from here to here. So it's about 118, 116 pips for today. So this was the move for today. You could have actually caught both moves. Come in here, buy, go up, hit your 70 pips, maybe look for reversal conditions, because you've got structural reference points. You have already created a high for this particular session, which was over here. And there's also another high there at 9:30. And because we've got bearish order flow in the market, this could have been a very good entry for a sell. So you could have gotten the buy, and you could have possibly gotten the sell if you knew what you were doing. Okay, but it's a brilliant question. I love it. Thank you so much for that, D.
Thank you so much.
All right, well done. Okay, cool, guys. You guys don't want me to sleep today, ne? Let's look. Okay, so other stuff. I will King, can you go through today's 10 and New York for us to how our mentor would have tackled today's trade? I would have tackled it exactly the same way that I just highlighted over here, Ken. Because this is what I did today, actually. It's a pity I didn't post it. But if you were on who was on my Instagram live when I was posting my my trade, I will look for that trade. I'm sure I maybe might have screenshotted it as well and taken it. But that's how I would have tackled it, because I did exactly the same thing. Okay. So can you please annotate for us internal? Okay, I'll do that tomorrow, because I don't wanna confuse you with internal clearing and external clearing today. Okay. So today's James Boku saw the live. So James saw the live and he saw that this is basically where we entered, right over here. Okay. And we rode it all the way to here. And when we're here, I told the jet, because he had to leave at 5. So we closed the trades over there, but he personally didn't enter this trade. I also personally didn't enter this trade, but it was a very, very good trade. I also had to close it here because we were installing some things in the office and so forth. Okay. Cool, guys. Yeah, we've been pushing for 2.5 hours now. Yeah, man. Well done, all of you. You guys can stay. This is my first group of mentees that actually stay this long for calls, eh? Unbelievable. Absolutely unbelievable. Well done to you all. I promise you, this is the first time that I have people that start from the beginning of the call all the way to the end of the call. And